Good morning to all of you, and welcome to those who are attending this seminar here at ESTEC Executive Education Center, as well as those who are going to participate through our webcasting service. It's a pleasure for me to welcome Ferdinando AMETRANO. Ferdinando is a senior quant at the Banca in Milan, as well as a senior lecturer at the University of Milan Bicocca, where he teaches a course in advanced fixed income. Today, Ferdinando is going to tell us about Bitcoin and other cryptocurrencies. He's going to make an overview of the subject and delve into the most important issues that are on as of today and will be part of our life in the next forthcoming years. So thanks again, Ferdinando, to come, and please.
Okay, thank you for inviting me. For those who attended the webinar, you can find my slide online. So they are already there, available to be downloaded from my speaker deck account. And we will talk today about what is the cryptocurrency frontier in commodity monetary standard. Let me start with some kind of a provocative thought. Money is a social relation instrument. Okay, this might be not the common point of view, but if you think about your own experience, as human beings, we are born into a gift economy. Our parents do not ask us to pay for the care they have provided, usually at least. And this gift economy is a relation circle that try to be as large as possible, to include family at large, oftentimes friends. But sooner or later, this circle of trust in which we are comfortable with the gift economy approach some kind of boundary. There are people we do not trust, and still we have to cooperate with them. And so the gift economy is not adapted for those kind of relationship. So we require some kind of exchange economy. The exchange economy, okay, in the history, some say it started with the barter economy and its own limits of coincidence of wants. People must have something to trade, which is of interest to both parties at the same time. While other economists challenge the notion of barter economy having ever existed, because there is no anthropological evidence of society based on barter economy. But still, the narrative of barter economy is good enough for my point. Definitely, we switch soon as humanity to a trade economy using money as medium of exchange. So money is exactly that medium that allow us to cooperate with people we do not trust. Okay, so it's basically a social relation instrument. In some way, I will say that Bitcoin is the best money for the information economy we're currently living in. I don't know where you were in 1994. I was at university, and I remember that I discovered electronic email, and I really enjoyed that technical mean. And I can remember explaining to my father about email, and he will not get it. He will say, well, faxes are instant, and I have registered a letter. And how do you get a receipt from your email? 20 years down the road, no business could live without electronic email. So I go with Mark Andreessen, which say that Bitcoin today is like internet in 94, weird and scary. Since then, we have experienced that encyclopedia has turned into Wikipedia, and music and film became liquid. And for worse or for bad, for worse or for good, there is a growing expectation that our smartphone can include a full-blown economic and financial system. And Bitcoin is in pole position because it has no transaction cost, no amount limits, no intermediaries, no frozen fund. It's always on, any day of the year, any time of the day. You can send Bitcoin from a Facebook account to Facebook account. It's the money for the information economy. You might be probably familiar with how humanity moved from the gold standard to what we call fiat money. Fiat in the Latin, as in the Latin word, fiat lux et lux fuit. Genesis, when God created light. Okay, and this is to fiat money, our legal tender money is called this way because its usability, its worthiness, is just because of a legal decision, because of a social contract. Let's remember that our banknotes are just useless paper if it was not for a social convention which we agree upon and that is kind of enforced by legal tender. In a way, I will tell you that if an alien will come into this room today and we had to explain to him the social convention behind our banknotes or the technological foundation of cryptocurrency like Bitcoin, I'm quite sure that he will find our banknotes much more clumsy to understand than what I will explain in a while. So let me frame this discussion on Bitcoin and the history of money, starting with Frederick August von Hayek, Economic Nobel Prize, in his wonderful book, Denationalization of Money. Hayek claimed in that book that history of money is largely a history of inflation engineered by government for their own gain. And he was quite upset that we accept government monopoly of money, not only because as every monopoly is giving us a bad product, but mostly because it has deprived us of the opportunity to discover and use better money. And he said, blessed will be the day when it will no longer be from the benevolence of the government that we expect good money, but from the regard of the banks for their own interest. And he was dreaming about banks issuing their own private money and competing among them for the more stable private money, so in a way, the better money. Well, his dream came true. It's not banks which are issuing private money, but peer-to-peer internet community. So here we come to Bitcoin. Bitcoin is a decentralized digital currency. Okay, well, these days all currency are mostly digital, so the news is not about being digital, but it is about being decentralized, which means that it is not backed by any central organization, no government, and still it allows instantaneous peer-to-peer transaction with no need for a trusted third party. It is based on cryptographic security, and it might represent low-cost banking for everybody, everywhere. It's not a toy. Just to give you an example, in the last December, a transaction for 200,000 Bitcoin, which were worth at the time about 83 million US dollar, has been transacted with just 4 cents of fee, for just a fee of 4 cents. So this is a real value transaction, basically performed for free. You might be familiar with Bitcoin USD exchange rate, which has been quite a roller coaster, as you can see. And December 2013, Bitcoin was kind of approaching 1,100 US dollar. And then it went down to 500. What happened that day? Well, Bank of China, Bank of People, the Chinese central bank, almost banished Bitcoin, not legally, but with a strong moral suasion, so that from that day on, Alibaba, the giant online web merchant in China, removed the prices in Bitcoin from his web, okay, because they already had Bitcoin prices. Of course, China accounted at that time for 80% of the traded volume of Bitcoin USD, US dollars. So there was a decline. And a few weeks later, while the exchange rate was recovering, there has been the failure of Mt. Gox, at the time the main USD dollar Bitcoin exchange. And the failure, it went bankrupt, and with probably fraud or theft, because the US dollar and Bitcoin of the clients of that exchange kind of disappeared. So a huge scandal, and the price has been declining since then. If you add to this the fact that Bitcoin is associated also with kind of the drug dealers, some of you might have heard about Silk Road, the deep web drug market. Well, this is quite a black picture, but still, there is nothing, I will say, in finance, which is only 6 years old, with not backing a government organization, which went through all of this and is still alive and kicking. And let's figure it out. Today is worth almost $250, and in March 2011 was worth $1. So nothing, there is no comparable startup that have experienced such a growth in the last 5 years. And venture capital are recognizing this. The investments in Bitcoin are skyrocketing, okay? And it will be easily, it might be easily reached $1 billion USD this year. But if you don't go with me, please listen to Oliver Bushman, the Chief Information Officer of UBS. He said that blockchain technology, the Bitcoin technology, will not only change the way we do payments, but it will change all trading and settlement topic. It has potential to trigger massive simplification of banking processes and cost structure. And the former director of the United States Mint makes no problem into let the world know that all major US banks have established team of experts focusing on digital currency. But Bitcoin, and this is the main takeaway of today, the first main takeaway of today, is two things. It's a currency and the protocol. Bitcoin with capital B, the protocol, also called blockchain, is much more powerful than the currency. The unit of the currency are usually indicated with lower b and in plurals. And we can say that Bitcoins are transferred using the Bitcoin protocol, okay? In a way, the currency is just the first powerful protocol application, the first digital property created inside the protocol. But the protocol is much more powerful. What is the protocol about? The protocol is about a distributed public ledger of transaction, which is called also blockchain. On this public ledger is shared with peer-to-peer technology. Some of you might be familiar with BitTorrent, which is a protocol that is used to share legally or illegally different kind of files, like music files, movie, documents, books. Okay, Bitcoin is called Bitcoin just because, in a way, it's the application of BitTorrent protocol, not really to coins, but to this special document, which is the public ledger of all transactions. So the node of the network, they all have access to the public ledger of all transactions since the inception of the Bitcoin currency, in this case. These public ledgers allow to transfer a digital unique token, because all of us, if we are nodes of the network, we can write a new transaction on the bottom of the existing public ledger of transaction. We have to do some work to do that, but we will see it in a while. The interesting technological breakthrough is that for the first time in digital realm, there is a token, a digital token, which can be exchanged but not duplicated. We are familiar with the fact that we can send our relatives an MP3 or a document or a video, and still we own that document, that video, that MP3. But in this case, if I transfer this digital token to somebody else, I don't have that digital token anymore. The digital token cannot be cloned. And this is a major breakthrough in technology. And so this public ledger keeps records of each and every transaction, but it has many powerful possibilities. In a sense, it can replace any peer-to-peer cryptographically secure equivalent. One application of the protocol without its monetary or currency part has been performed by NASDAQ starting last week, because NASDAQ declared that it will start using the blockchain Bitcoin technology for pre-IPO trading among private companies. So the pre-IPO trading these days is done with emails from lawyer to lawyer and updating huge, unreliable, in a way, spreadsheets, which needs to be reconciled before the actual IPO. Well, now the digital token is representing some pre-IPO share that can be traded between private companies on a public ledger of transaction, which has not to be reconciled, which is public for everybody and cannot be manipulated or tampered with. Many more applications are possible. We talk about smart properties, we talk about smart contract, but the most interesting thing, which sounds kind of cyberpunk in a way, is talking about autonomous agents. Software programs created for specific tasks that are able to make and receive payment using Bitcoin. And so in a way, they can do operations that this day we are used to think to be performed by organization. So there are people talking about decentralized autonomous organizations. And we will see one kind of special decentralized autonomous organization today during my talk. But let's go back to the Bitcoin currency, because the Bitcoin protocol, well, we could be talking for days about exciting new possibilities. But let's focus on the killer application these days of that protocol, which is the Bitcoin currency. So Bitcoins are not to be found anywhere. They only exist as public ledger documented transactions. As an example, this is my Bitcoin wallet, which is a public address, and this is the equivalent QR code. We have said that is a public address, so on the public ledger, everybody can verify how many Bitcoins are associated to this wallet of mine. And please go and check it on yourself. If you click on this link, you see the history, the internet version, the internet interface, the blockchain to the public ledger transaction, with all transactions which have involved one of my wallet, okay? And if you're grateful about this powerful introduction to such a disruptive innovation, down the road you might just send a tip my way, just a tip. I'm not really interested into the monetary value or whatever you can send my way, but as a token of appreciation, yes, that I will be grateful for that. So the Bitcoin's public ledger is called blockchain. Why this kind of strange name? Because Bitcoin transactions are bundled in blocks, one block every 10 minutes, and they are sequentially chained. So the public ledger is actually a chain of transaction blocks. That's why it's called blockchain. The blockchain is the history of transaction, and it's very resilient to network attackers. Why that? Because the cryptographic link between blocks require a large amount of computing power, setting the level of effort required to alter the blockchain. If you check the current statistics, you will see that this day, the Bitcoin network has an hashing capacity, a computing power, a very specialized computing power capacity, which is 13,000 times higher than that of the combined 500 largest supercomputers. Okay, of course, the 500 largest supercomputers are much more flexible, but at the single task of validating transaction through a computational action which is called hashing, the network of specialized hardware built up around the Bitcoin protocol is much, much more powerful. Who's providing this computational power? The so-called miners. Miners are the node of the network providing this computing power for processing and validating transactions, securing the network, and synchronizing the nodes. So in a way, the miners are just a decentralized back office validating transactions. They compete among themselves to be the first to process a new block of transaction. They compete because the winner, that is the one providing a proof of work, the proof of work of having validated block, is rewarded with the issue of new Bitcoins. So this is a very clever idea in the protocol, in the Bitcoin protocol, because seigniorage revenues are used to cover the cost of the validation network. So the reason why Bitcoin transactions are practically free from cost. We have seen 4 cents for an 83 million US dollar transaction is because the cost of the network is covered by seigniorage revenues. And the cost is pretty much relevant in a way because seigniorage revenue are used to cover for it. But the most interesting thing, which is related to the mining activity, is that the monetary policy of Bitcoin is deterministic and completely inelastic. New Bitcoin are issued to cover the block validation duty. And the original reward was 50 Bitcoin, so 50 new Bitcoin every 10 minutes, every block. And it's held every 4 years. And so, of course, will be diminishing. And we are already on a good percentage of the old Bitcoin which have been issued. And the last Bitcoin will be issued in 2141, sorry. But this completely inelastic monetary policy introduced us to the problem with probably the most relevant problem Bitcoin is facing today. Because successful at getting rid of centralized monetary authority, Bitcoin has given up the flexibility of an elastic supply of money. And so the supply cannot adapt to change in demand. And as demand for Bitcoin has increased very much in the last 5 years, what has happened to price in Bitcoin is that they crashed to almost zero. So whatever you were able to buy with 1 Bitcoin in March 2011, you could buy with hundreds or thousands of Bitcoin 5 years later, 3 years later, sorry. In comparison, whatever you could buy with $1 in March of 2011, 3 years later, it will cost just $1.06, according to the Fed's policy of 2% inflation per annum. Okay, but from an investor point of view, the huge appreciation of Bitcoin is a great news. But you cannot pay salaries in Bitcoin. You cannot have a mortgage in Bitcoin. you cannot have a forward payment in Bitcoin, because the purchasing power equivalent of that payment is subject to too dramatic volatility, okay? Because of the completely inelastic monetary policy. So it's almost easy to think about a second generation of cryptocurrency which might adopt an elastic monetary policy, and this is what I call Hayek money. So let's think about what is money before tackling what Hayek money is. One of the duty of money is to be unit of account. Money is used as numeraire. So money is the unit of account against which the value of every other good is measured. Let's think about the linear meter, and let's imagine a world where the linear meter shrinks or enlarges every day, and like crazy, we have to go around and keep measuring again and again and again lengths and distances. It will be a crazy world. Well, when it comes to money, this world is quite crazy, because money is the unit of measure of prices. And since money changes in value, we have to readapt, remeasure, reprice all other goods. So it should be clear that good money should provide stable prices to best perform its role as unit of account. And when we compare different kind of money, we can easily say that Bitcoin is the best medium of exchange ever, because we know that it's swappable, fungible, portable, divisible. And we cannot say the same about diamonds, as an example, because diamonds can be divided, but the two halves won't be worth as much as the units they came from. Bitcoin is a very good store of value because it's a non-perishable and with a very low preservation cost, okay? So why not 5 stars? Well, many critics are worried about Bitcoin relying on cryptographic security. What if cryptography might be break by some unknown technological breakthrough? Well, this discussion will take us very far, but let me say that first off, cryptography cannot be really broken. Cryptography is mathematics. Mathematics cannot be broken. Of course, mathematics could be badly implemented, in which case the resulting software will be broken. But in that case, trust me, I won't be worried about my Bitcoins. I would be worried about nuclear weapons. I would be worried about my privacy. I would be worried about financial systems, because all these kind of things are based on cryptographic security, not just Bitcoin. So we're back to the key point of unit of account. And we already know that Bitcoin as unit of account is not good. But well, even fiat currencies have not been historically good. Without going back to the Weimar Republic and the Deutschmark, we have many examples of hyperinflation destroying fiat currencies. What is sure is that if we restrict our analysis to the last 20 years of the USD dollar, the US dollar, and the euro, probably fiat currency deserve at least 4 stars. Bitcoin will ever be able to catch up on this? Yes, it will. It will if we try to engineer a different kind of cryptocurrency with elastic supply. So let me go through an example, which is not realistic, just didactical. And we already discovered that in April 2011, one US dollar was worth 1 Bitcoin. And in March 2014, one Bitcoin was worth 500 US dollar. So in that period, there has been a 500 times increase for Bitcoin demand compared to, or relative to, USD demand. In March 2014, there were around about 12 million Bitcoins. Now, if by some magic power I could have inflated the number of Bitcoin by a factor of exactly 500. On March 2014, it would have been completely equivalent for anyone to own one Bitcoin worth 500 US dollar, or to own 500 rebased Bitcoin, each one worth just $1 US. What would happen is that the history of Bitcoin, instead of being that roller coaster chart we have seen at the beginning, would have been this one. And of course, we do not want to really buy the US dollar, the Fed monetary policy, if we want to launch a new private money. So we better peg our new cryptocurrency maybe to a basket of commodity. So I just made up, for the tactical example, a basket comprised of Brent and wet. And this is the price of this basket in US dollar. So compared to this basket, US dollar has experienced those 3 years a small deflation. Okay. Bitcoin, of course, huge deflation, as we have learned before. But now, if I define this rebased Bitcoin as I sketched before, all of a sudden, I can have a fixed, completely flat price for that same basket of commodities in terms of rebased Bitcoin. So the rebased Bitcoin is a currency that, if I compare its volatility with the volatility of the US dollar euro exchange rate, they're on the same chart. Okay, pretty good, pretty good. Now, this first simplistic implementation of IAC money has some limit. There has been a number of critics pointing out that the number of coin in a wallet will change without any direct inflow or outflows, and this is definitely something we are not used to. I'm not really buying this criticism because, well, I can tell you, I have a bank account. I don't know how much money is exactly on that bank account. I know if I can draw from that bank account 100 euros, 1,000 euros, 10,000 euros, but I don't know exactly how many euros are on my bank account. So I don't think that this will be really, really so puzzling for people to accept. Of course, critics keep going on and say, okay, you have just moved price volatility into money volatility. So it's the number of coins in the wallet which change. Okay, but let's move to some goal we have achieved with that. Prices are stable, which means that now salaries and mortgages can be possible. The purchasing power, of course, of a given wallet is not stable. So we are halfway through. Can we do something better? Yes, we can. But the real reason for trying to do something better is because Bitcoin has experienced such a dramatic appreciation that people are hoarding Bitcoin. They buy Bitcoin in expectation of its future value appreciation. But because of that, they don't want to spend Bitcoin. So transactions in Bitcoin are not really growing at an exponential rate. So in a way, the Bitcoin has such a speculative appeal that people prefer to keep it, to store it in their vault, to hoard it, than to spend it. And even in the first simplistic implementation of IAC money, which I've just proposed, the speculative appeal of a coin is still there, because you don't want to spend your coin, because when the monetary base will be rebased, a new coin will be issued, it's just the ownership of the original coin which will entitle you of the new Bitcoins. So with my first simplistic proposal, coins still retain speculative investment appeal, and so enjoy limited transaction usage. Let's try to do better. Let's try to implement IEC money, that is an elastic supply of money in a cryptocurrency, as a dual asset ledger. Let's split transactional and speculative money demand with two non-fungible assets: stable transactional coins, unstable speculative shares. Of course, we will have blockchain technology to track ownership and transactions for both. As soon as we introduce coins and shares with their respective prices, the monetary base, of course, is comprised of the coin market capitalization and the share market capitalization. And of course, if it happens that the price of the coin goes to zero and the price of the share goes to zero, okay, bad news, the cryptocurrency is dead. We cannot do anything about that. Talk about the Zimbabwe currency. If nobody wants your currency, you're dead. If someday nobody will want our euro, we're dead. That's it. Fact of life. But it may happen that the coin price is zero while the share price is greater than zero. Okay, if this happens, this means that there is no interest for stablecoin. Everybody is just happy with the shares, but the shares are completely equivalent of Bitcoin. So I'm wrong. The world is happy with Bitcoin as it is, and this new kind of cryptocurrency will not survive. But if we dismiss these two extreme scenarios, and so we consider in the following that we always assume that the price of the coin will be greater than zero. But let's keep in mind that our goal is that the price of the coin, we want it to be one. One, at least as expressed in terms of the price index cost, okay? Whatever this commodity price index might be. So the supply of coin is regulated to peg the coin to a given price index parity. And so in expansionary monetary phases, new coins are minted as share dividends, which will be paid to shareholders. In contractionary monetary phase, coin will be destroyed or burned in exchange for newly minted shares or other crypto asset. For the time being, allow me not to specify what other crypto asset might be, but we will go back to this point in time. Okay. Of course, the first part is the easy part. When the coins is appreciating, issuing new coins as a reward, as a dividend to shareholder is easy. It's when the coin value is dropping and we have to reduce the amount of coins in circulation, the things becomes hard, and we will have to verify if we can really reduce the amount of coins in circulation using this approach. Of course, if we are successful, if the coin price is about 1, coins give up any speculative value, and so money velocity and transaction volume will increase. And of course, we will have to reward the transaction validation, not with the issuance of new coins, because we don't want to stick to a deterministic monetary policy, but with the issuance of new shares. These shares, I love to call them seigniorage shares, because in a way, they enjoy the seigniorage revenues and the seigniorage associated cost. They are, in a way, shares into a distributed central bank. So miners are replaced in this scenario by shareholders entitled to seigniorage revenues as compensation for being not only obliged to validation task duties and their responsibility for network security, node synchronization, and so on, but especially because shareholders are subjected to the cost associated with coin stability. So these seigniorage shares, well, in a way, the market cap, the share market cap, is the estimation of future coin issuance. If you assume zero interest rate, the market cap of shares divided the price of the coin is the expected number of future coins to be issued. So the share price is free to float and to increase for dividend expectation in expansionary monetary phases and decrease in contractionary phases when no new coins are expected. So shareholders will absorb all monetary policy costs and benefit, shielding coin holders from any residual volatility. Shares will never be burned or destroyed. In the epic case of price of coin being greater than 1, fresh new coins will be minted and paid as share dividends to shareholders. And for a given transactional coin demand, which is satisfied by the market capitalization of coins, and increasing the number of coins will, of course, push the price of every coin down to parity. If the price of the coin is greater than 1, of course, the price of the share will always be greater than 0, because new coins are expected to be paid as dividends to shareholders, and so the share price will be always greater than 0. The problematic case of price of the coin being below 1, no dividends are expected on short terms, so the price of the share decreases. A decreasing share price implies that less coins are expected to be minted in the future, so the current price of the coin is pulled up to parity proportionally to the market share capitalization loss. Less new coins are expected to be minted in the future, the existing coins are worth more. Coins can also be voluntarily burned in exchange for newly minted shares or other crypto assets. And we now approach what this other crypto asset might be. But why we need other crypto assets? Because in this problematic case of coin price being below 1, of course, if the price of the share is greater than 0, coin price parity might be still restored by share intrinsic devaluation or coin burning. But if the price of the share drops to 0, the share's defensive help is exhausted, and price stability should be preserved only burning coins. But burning coins for new shares will not be attractive because the share price will be negligible. So that's why we need another crypto asset which can be used as a compensation for burning coins. And this is where we introduce the decentralized reserve bank as decentralized autonomous organization. I promise you exactly that we will have seen today an example of decentralized autonomous organization. We just realized that as monetary policy tools, share dividends and coin burning, since they are kind of, let's say, behavioral finance, they might be not really effective enough to enforce coin price parity. So we need a reserve bank software, a reserve bank organization implemented as software, which can enforce price boundaries. Let's remember that crypto asset wallets are digital. So we have software which can transact in crypto assets. And so we can have our reserve bank to be always available to sell newly minted coins for, let's say, 1.05, accepting crypto asset to be accumulated as reserve in return. And this reserve bank is always willing to buy existing coins at 0.95, giving new share in return, as we said, or giving in return the accumulated reserve crypto assets. The crypto assets must be crypto assets, cannot be just generic assets, cannot be euro, USD dollar, or gold, because in that case we will need a custodian legal entity which will reintroduce centralization in a currency, let's remember it, that we want to be completely decentralized with no central authority. Okay, so the crypto asset must be Bitcoin. We plan to leverage Bitcoin as reserve asset because Bitcoin is the first and most successful instance of an intrinsically scarce digital asset. Bitcoin is digital gold. So when used as reserve asset, we are magnifying Bitcoin qualities and we are lessening its limit because Bitcoin will not need to scale to huge number of transactions, which is currently a problem, will not need to support economically inefficient micropayments, and will not need to achieve lower confirmation times below the 10 minutes validation block. So we will be making the maximum out of Bitcoin. And we can even dream about the Reserve Bank IPO. So we launched the new coin, launching the IPO of the Reserve Bank, raising Bitcoins and issuing seniority share. And if I were to launch such a Reserve Bank, I will not be asking investor, please give me your Bitcoins. But I will be asking, please give all of us which are interested into it, our Bitcoins to a software, to a Reserve Bank software, which will use these assets, these reserve assets, to enforce price parity. So we can see Bitcoin as digital gold in the history of crypto money because gold for centuries has been the most successful form of money. Its adoption was not centrally planned, and it has been surpassed by other kinds of money without becoming obsolete. Well, Bitcoin is the most successful form of cryptocurrency. Its adoption has not been centrally planned, and it might be surpassed by more advanced type of cryptocurrencies without becoming obsolete. One last piece in the design I'm proposing will be to switch transaction validation from the proof of work we have seen in Bitcoin to a mix of proof of stake and what I call proof of payment. We do not want, we already say that Bitcoin proof of work might be seen as wasting of resources in favor of network security. I don't see it this way. I think this is the cost of security. It's not a waste. But definitely, we don't want to charge additional cost for building some new cryptocurrency on the top of Bitcoin. So the transaction validation rights, well, we split them proportionally to shareholder. And so we introduce, I'm not the first one to propose something like that, which is called proof of stake. But instead of wasting hardware and electric power in proof of work, shareholders will pay Bitcoins to the Reserve Bank for the right to validate a new block of transaction and receiving in return a newly minted share. So this will be a crucial point because it will be a continuous stream augmenting the reserve asset at the Reserve Bank, and will be very effective so into feeding the Reserve Bank with a reserve asset which the bank might use to defend the coin parity. And it becomes clear that shareholders, and so share prices, should be at least worth the reserve which are stored at the Reserve Bank. So it is easy to see that share prices will be at least worth the amount of reserve asset of Bitcoin stored at the Reserve Bank plus the expected future coins still to be minted. So to conclude my presentation, I hope that it's clear now that Bitcoin is a disruptive invention. From the technology point of view, which we didn't discuss too much today, we are facing endless possibility in replacing many different central authorities. I think that the real challenge today is to really imagine what could be the forthcoming blockchain equivalent of Apple, Google, Amazon, and Facebook. Going back to the 1994 example of electronic email, nobody at that time could have thought that we would have bought our music and books online, we would have arranged our dinner with friends using social network, we would have asked natural human language question to a computer, expecting the computer to provide sensible answer as we do with Google. That would be not conceivable in 1994. Still, this has happened. This is what will happen with blockchain technology when clever, smart people would think about some usage, new usage of the blockchain technology. But as in 1994, email was the killer application, I can tell you that in 2014, the killer application of the Bitcoin technology is money. We are on the eve of possibly the best money ever devised in human history, and at least for sure, we can take it for sure that payment system and exchange will never be the same. And Bitcoin is just the first step in the history of crypto money. The second step will be the implementation, the smart implementation of the Hayek money paradigm of elastic non-discretionary money supply, which could be implemented as a coin-share dual asset ledger to decouple transactional and speculative money demand. We will use Bitcoin as reserve asset for a software which acts as decentralized reserve bank. So a decentralized autonomous organization that performs market operation. And last but not least, we could use proof of payment to avoid increasingly socially inefficient usage of seigniorage revenue for transaction validation. Okay, there is some bibliography that you can peruse after my talk if you're interested. Of course, the Nakamoto paper, the Antonopoulos free book, and the Pedro Franco technical exposition of Bitcoin. There is my original paper on Hayek money, the cryptocurrency price stability solution. Some intermediate proposal of how to achieve price stability, and my new paper on cryptocurrency price stability with seigniorage share and reserve bank, which is very much in depth with the idea of Robert Sams, which has pioneered as a first author the idea of using a dual asset ledger, but has provided an implementation which I think could be improved by what I have exposed today. Okay, thank you for your attention. I am available for questions, if any.
Thank you. I have a question. What can go wrong?
A lot of things. Especially, I would say, buggy software. So there is some software to be written, some software to be tested. And since we are going to rely on this software for building up a new kind of economy, of course, this software should be really, really extensively tested. We're lucky. The Bitcoin code base has been tested for 6 years now, and has been proven to be resistant to any kind of attack. Of course, we want to build something on the top of it, and so we should leverage, definitely, the Bitcoin experience, and also try it in a soft way. I will say that, in a way, if I were to launch a reserve asset bank IPO tomorrow, I will be kind of an entrepreneur. Your money will be at risk. You will be funding my venture. If I execute it right, we all become rich, because this is the future of money. Of course, I might be wrong, and the implementation, the execution, the first execution, maybe the second execution, might be problematic. We're lucky enough that beside Bitcoin, there is an ecosystem of alternative coins. Most of them are not really relevant, but few of them are quite interesting. As an example, they are experimenting. One relevant experiment will be Ethereum, which is a very flexible platform on which you can really try to engineer and test this new kind of money. Another less interesting experience, but still worth looking, it's new shares. They try to achieve parity. In my opinion, they do this in a very naive way, but still, it will be nice to take a look at these experiments and how they go. But first, sooner or later, I might say, someone will get it right and will do it. And our kids will laugh when we will say to them that today we have a leather wallet and a smartphone, and why we still use this. So digital money is on the arrival. And when digital money will be arrived, the switch from legal tender money to private money will be tempting, in my opinion.
Okay. Thank you. I would like to start a question. Who is the guarantor of cryptographic security?
Mathematics. Cryptography is a branch of mathematics, which is based, there are many different areas. The one we are interested into is asymmetric cryptography. Asymmetric cryptography is the idea of a private and public key. Is the one we use to sign documents. Is the one we use for securely sign on our banking website. So there is no guarantor of cryptography per se, but there is no guarantor that 2 + 2 is 4. That is just true. Okay, so cryptography, if you look at it as a branch of mathematics, does not need a guarantor. Of course, we need to take care that the software implementation of cryptographic mathematics should be sound and robust, and it could be buggy. So that is where we will need to invest a lot of effort. And this is better done, as any cryptographer will tell you, using open source software. There is no cryptographic tool which is closed source, because if you have to rely on cryptography, you want to see the source code with your own eyes and be able to inspect that and to put that to a public scrutiny for everybody. But these are pretty common practice in cryptography as a scientific discipline. Okay?
Yes, because in gold we trust, because you can check the physical property of gold, for example, and for euro or US dollars, we trust in our national government in case of problem. So here we trust in technology.
I do understand your point, because this lecture has been focused on monetary policy. As an example, yesterday I gave a lecture to the SX students, which was 3 hours, and half of it was devoted into going deep into the technology. Because I can feel that, of course, you say, how robust is this technology? We don't have time here to go deep into this kind of details. Let me try to answer with a provocative sentence. The Bitcoin market capitalization is few billions worth now. If the technology could have been broken, somebody would have done that. If it's still out there resisting any attempt of cybercrime, it's probably strong enough. And more on this, I will refer you to some of the text in the bibliography I provided, or even the slide of my yesterday lesson, which are on my speaker deck. Okay?
Thank you.
Okay, we can close it here.
That's it. Thanks.
Thank you, everybody. Thank you, everybody.
Okay, I take this opportunity to thank again Ferdinando, and also to state that our next webinar will allow for you to attend the 2 workshops, one in energy finance and the other in commodity finance, that will be held at the SEC Business School on June 1st and June 2nd, directly from our SEC Business School Cergy campus. Okay, thank you and see you soon.
Thank you.